The United States government values its gold at $42 an ounce. The market price is over $5,000. That is not an accounting error. That is a $750 billion weapon sitting on the Treasury's balance sheet, and nobody in Washington wants to talk about it. Trump ordered a Fort Knox audit. Elon Musk offered to film it. Then Treasury Secretary Besson came out and said all the gold is present and accounted for, and everyone went silent. No audit, no video, no explanation. Meanwhile, the World Gold Council just reported that 95% of central banks plan to increase their gold reserves this year, the highest level of optimism in the survey's 8-year history. China just bought gold for the 15th consecutive month, and Wells Fargo raised their year-end target from $4,700 to $6,300, a $1,600 upgrade in a single revision. Something is happening that they are not telling you. And when you understand what central banks are actually preparing for, you will never look at a dollar bill the same way again. My name is Alex, and I have spent the last decade tracking commodity cycles, central bank policy, and sovereign debt filings so you do not have to. If you want to understand what is really happening with your money and the global financial system, make sure to hit that subscribe button and give this video a thumbs up if it opens your eyes to something new. Before we dive in, I want to know, do you own any physical gold or silver, or are you still on the sidelines watching? Drop your answer in the comments because I genuinely want to know where this audience stands. Here's what this video is really about. Gold is not just rising because of inflation or fear. Gold is rising because the institutions that literally print money are telling you, through their actions, that they do not trust the system they built. And there is a specific playbook for what happens next. I'm going to walk you through it piece by piece. But first, you need to understand why the old rules no longer apply. Most people think gold is a relic, something your grandfather kept in a safe. Financial advisors will tell you it does not pay a dividend, it does not generate income, and it just sits there. Here is what nobody tells you about that advice. It is built on an assumption that the financial system will always function normally, that the dollar will always be the world's reserve currency, that the United States government will always pay its debts, and that the rules will never change in the middle of the game. But here's the thing, the rules already changed. In 2022, when Russia invaded Ukraine, the United States and its allies froze over $300 billion in Russian central bank reserves. Overnight, every central bank on the planet learned a lesson they will never forget. Your dollar reserves, your treasury holdings, your supposedly safe assets can be turned off like a light switch if you end up on the wrong side of geopolitics. That single moment rewired the entire global financial architecture. And gold, the one asset that cannot be frozen, cannot be sanctioned, cannot be printed, and cannot be defaulted on, became the most important asset on Earth. Not to retail investors, to the people who run the money supply. Central banks bought 1,136 tons of gold in 2022. That was an all-time record. They followed it up with over 1,000 tons in 2023, over 1,000 tons again in 2024, and 863 tons in 2025, which was still the fourth largest year on record and nearly double the average annual purchases from 2010 through 2021. 4 consecutive years above 860 tons, 3 of those above 1,000. This is not a blip, this is a structural shift. And what I am about to show you next is the part that took me months of reading central bank reports to fully piece together. Let me walk you through the 5 forces that are converging right now, because when you see them together, the picture becomes impossible to ignore. The first force is the debt spiral. The United States national debt has crossed $36 trillion. Let that settle in your mind for a moment. Interest payments alone now exceed $1 trillion per year. That means before the government spends a single dollar on defense, infrastructure, social security, or anything else, it has to pay over $1 trillion just to service its existing debt. And here's the math that keeps Treasury officials up at night. When you are borrowing money to pay interest on money you already borrowed, that is not a budget problem. That is a structural collapse in slow motion. Japan is at 230% debt to GDP. Most developed nations are at record levels. The Buffett indicator, which measures total stock market capitalization to GDP, is above 220%. The Shiller-KP ratio is above 40, the second highest reading ever. The only comparable period was the dot-com bubble, and we all know how that ended. The second force is currency debasement, and this is where it gets personal. A dollar in 1971, the year Nixon took the United States off the gold standard, is worth about 14 cents today. That is an 86% loss in purchasing power, not over centuries, over a single lifetime. Meanwhile, 1 ounce of gold in 1971 cost $35. That same ounce today costs over $5,000. That is a 14,000% increase against the dollar. The dollar is designed to lose value. The Federal Reserve literally targets 2% inflation per year. Gold is not designed at all, it just sits there. And somehow, sitting there has beaten every central bank's managed currency over the last 50 years. I'm going to share something controversial in a minute about what the US government might do with its gold. But you need to understand the third force first. If you have made it this far, you are already ahead of 90% of people watching. But do not stop now, because the next part is where everything clicks. The third force is de-dollarization. 12 countries have reduced their dollar reserve holdings significantly since 2022. China's central bank, the PBOC, has been buying gold for 15 consecutive months, straight through January 2026. Their current holdings sit at 74.19 million fine troy ounces, valued at $369 billion. But China is not alone. According to the World Gold Council's 2026 survey, 95% of central banks expect global gold reserves to increase over the next 12 months. That is up from roughly 70% in previous years, the highest level of optimism in the survey's 8-year history. Think about what that means. The institutions that create money are telling you, in writing, that they are moving away from each other's currencies and toward gold. They are not speculating. They are not day trading. They are restructuring the global monetary system in real time. The fourth force is the supply constraint, and this is the one almost nobody talks about. The world only mines about 3,000 tons of gold per year. There have been no major new discoveries. The lead time for a new gold mine is over 10 years from discovery to production. All the gold ever mined in human history totals roughly 120,000 metric tons. Now compare that to demand. J.P. Morgan's 2026 forecast projects average quarterly demand of 585 tons. That breaks down to 190 tons per quarter from central banks, 330 tons from bar and coin buyers, and 275 tons annually from ETFs and futures. That is nearly 2,400 tons of demand per year just from those three sources. Mining produces 3,000. The physical market is getting tighter every quarter. And in January 2026, we saw the largest monthly ETF inflow in history, $19 billion in a single month. Global ETF assets under management hit $669 billion. Total global ETF holdings reached 4,145 tons, an all-time record. When supply is inelastic and demand is accelerating from every direction, there is only one way to balance the market. Price goes up, which is exactly what the banks are forecasting. Now, here is where I need to get a little uncomfortable with you, because the fifth force is the one that sounds like a conspiracy theory until you read the actual law. The fifth force is the gold revaluation question. The United States holds 261.5 million ounces of gold. That is 8,133 tons, the largest sovereign gold reserve on Earth. But on the Treasury's books, that gold is valued at $42.22 per ounce, a price set in 1973. At that valuation, America's gold is worth roughly $11 billion. At the current market price of around $5,000 per ounce, it is worth approximately $1.3 trillion. The unrealized gain is over $750 billion. Now here is what most people do not know. Under the Gold Reserve Act of 1934, the Treasury has the legal authority to revalue that gold to market price, issue new gold certificates, and have the Federal Reserve credit the Treasury's account with the difference. No new debt, no new taxes, no congressional approval required. In February 2025, Trump announced plans to audit Fort Knox. Musk offered to livestream it. Treasury Secretary Bessent said, and I quote, "We are going to monetize the asset side of the U.S. balance sheet." Then in March 2025, Bessent walked it back. He said gold revaluation is not what I meant. Then, in February 2026, he simply said all the gold is present and accounted for. No audit was released, no video, just silence. Meanwhile, a Federal Reserve study published in August 2025 analyzed gold revaluation scenarios. Germany has done this. Italy has done this. South Africa has done this. The legal mechanism exists. The fiscal incentive is enormous. The question is not whether it is possible. The question is why it has not happened yet, and more importantly, what they are waiting for. Let me now walk you through exactly what happens when the next financial crisis hits, because there is a playbook, and it has repeated twice in the last 20 years. Phase 1, asset prices crash. Stocks, bonds, and real estate fall simultaneously. Leverage positions get liquidated. Cash becomes king temporarily. Phase 2, central banks respond. Emergency rate cuts, quantitative easing, bailouts and stimulus programs. Phase 3, currency debasement. The newly printed money chases assets. Inflation accelerates. Purchasing power drops. Phase 4, hard assets surge. Gold, silver, and commodities rise. Real assets outperform paper. Those holding gold preserve wealth while everyone else watches their savings evaporate. We saw this exact sequence play out in 2008 through 2011. After the Fed launched quantitative easing, gold tripled. We saw it again from 2020 through 2026. After COVID stimulus, gold went from 1,800 to over 5,000, a 178% gain. The pattern is not theory, it is history. Now I know what you are thinking. Alex, gold is already up 72% year over year. It hit 55.94 in January 2026 before correcting 21%. Is not it too late? That is the trap right there. Because that is exactly what people said when gold broke 4,000 in October 2025. And what happened? It ran to 55.94 3 months later. Then it corrected, and now it is stabilized above 5,000. Wells Fargo just raised their year-end 2026 target to $6,100 to $6,300. JP Morgan raised theirs to $6,300. Deutsche Bank says 6,000. UBS says 6,000 plus. Societe Generale and BNP Paribas both say 6,000. Even Goldman Sachs, historically conservative on metals, is projecting a 50-55 average for the year. The institutions that manage trillions of dollars are not calling a top. They are calling for another 20 to 26% upside from here. But here is a hard truth that might sting a little. Gold is not about getting rich. It never was. You do not buy fire insurance because you are hoping your house burns down. You buy it because if it does, you are not financially destroyed. Gold is crisis insurance. It is a store of value when currencies fail. It has no counterparty risk. It cannot be printed, frozen, or defaulted on. It has 5,000 years of history as money. And right now, the people who manage the global monetary system are buying it at the fastest pace in recorded history. Now let me tie all of this together, because when you see how these pieces connect, the picture becomes undeniable. Central banks are buying gold because they see the debt spiral accelerating. They see currency debasement continuing. They see de-dollarization gaining momentum. They see supply constraints tightening. And they may even see a gold revaluation on the horizon that would fundamentally reset the monetary system. This is not speculation. These are data points from the World Gold Council, JP Morgan, Wells Fargo, the Federal Reserve, and the People's Bank of China. Named sources. Verified numbers. The bear case exists and it is fair. Gold pays no yield. Treasury bills still pay over 4%. If the Fed tightens further, gold could fall short term. A strong dollar could pressure prices. And yes, some analysts warn this could be a retail trap at $6,000 targets. But the bull case response is structural. Yield does not matter if the currency it is paid in loses value faster. The Fed has limited room to tighten with recession risk looming. The dollar has been weakening against gold for 50 years, and central bank demand is not a retail fad. It is a generational shift. Remember where we started. The US government values its gold at $42 an ounce. The market says 5,000. Central banks are buying at historic levels. The audit went silent, and 95% of the institutions that literally create money are telling you they plan to buy more gold this year. You started this video wondering what they are not telling you. Now you know. They are not telling you that the system they built is showing cracks they cannot patch with more debt. They are not telling you that the insurance policy they are buying for themselves is the same one they have been telling you is unnecessary. They are telling you everything you need to know, not through their words, but through their actions. The question is whether you are paying attention. Gold, silver, the dollar, the Fed, central bank policy. What is the next topic you want me to dig into? Drop it in the comments below because that is exactly what this channel is for. Your future self is not counting on you to predict the next crisis. Your future self is counting on you to be prepared for it. And preparation does not start when the headlines get scary. It starts right now.